tuned into Markets Weekly on Money Control. I'm Karunya Rao, and as always, every week on Friday 4 p.m. we get you all the action that has transpired in the week gone by and cues to watch for the next week. Atul Bhole, Senior Vice President from DSP, joins in today. Atul, thank you so much for taking time out.
Thank you. Good evening, and thanks for having me on your channel.
It's been a very exciting and eventful week for the markets. Starting on Monday, we saw the mega merger announcement from HDFC Limited with HDFC Bank. Of course, banks have been the big talking point this week. Talk to us about how you guys at DSP are assessing this merger news and overall at the banking space. What is your view?
So on the overall banking space, we are pretty bullish on the overall banking space. I mean, we have been seeing that for last 5-6 years, banks have been busy clearing their bad debts or the asset problems. And now most of the banks have pretty clean balance sheets. And now we are also looking at credit growth just picking up. We have seen good amount of inflation in the commodities, and hence the mid corporates or even larger corporates will see working capital requirements picking up. So that will boost the credit growth. Also, we are on the cusp of rising interest rate scenario, which is obviously plays out good for banks, especially having good amount of CASA. So overall, we are bullish on the banks with this fundamental reason, as well as looking at the valuation. The valuation of most of the banks are below historical averages, as well as if you look at on the relative basis compared to most of the sector, banking stocks are trading at very reasonable valuation given the growth outlook and the return ratios. So we are pretty bullish on the overall banking space and even on some of the NBFCs. And particularly regarding the latest happenings, including today's policy, I think all these events which are happening augurs well for the sector, including the consolidation which is happening. India needs bigger and larger banks for supplying credit to the industry, etc. So we are looking at all these things favorably.
Right. Banks, in fact, interestingly, have also done well on the stock prices front as well. Good momentum seen there. Last 1 month has been especially quite exciting for the banking stocks. But tell me something. You said valuations are good, valuations are attractive. Does that apply to private sector lenders particularly, or even PSBs, perhaps something like an SBI, Canara Bank or BOB also is something that you like?
So actually, we are more tilted towards private banks, but overall, even including PSU Bank, I think valuations are looking very favorable. Given the valuations are below historical averages, and we are looking at credit growth as well as very good earning growth is about to happen because that whatever credit growth and related improvement we will see will directly can flow to bottom line because we don't have credit cost going forward in a bigger way like we have seen in the past. So when we mention banks, I think it applies to both private as well as PSU banks. We are taking a view or tilt more towards private banks.
Okay. And how are you reading into the RBI governor's commentary today? They said this stance is accommodative, but they want to roll back the whole host of accommodating initiatives that they had doled out, of course, over a multi-year time period. So yes, they're being cautious about it. But do you think net it was expected and markets will, move on with it?
Right. I think we have also been hearing the economic advisor of the Prime Minister, etc. And we are seeing a lot of confidence from the government as well as RBI side in terms of resilience of the economy. And we can vouch it with the twin sort of parameters like yields as well as the currency. Even when oil going to 120, I mean, for some time and now remaining above 100, both the parameters of yield as well as currency are behaving very nicely for India. And a lot of reforms which has happened in past 6-8 years is the reason behind this stability. So I would say macro stability is reaffirmed for India, and probably that is giving a lot of confidence to RBI as well as government. So in case of RBI is still saying accommodative while world over central banks are moving towards withdrawing the stimulus as well as raising rates, starting to raise rates, etc. While RBI is still maintaining that accommodative stance and taking a very gradual approach, giving still preference towards growth, which is required. So I think market should take it favorably, I would guess, and I would believe that market will take it favorably because our macro stability is established, and the regulator as well as government is working for growth while keeping an eye on inflation. So I think it is good for, works very well for Indian markets.
Since you brought up the topic of inflation, are you, are you looking at any sectors or any themes that could be interesting bets against this inflationary environment that we're looking at? Any themes that you think are a good hedge or protected from the overall inflation that we're seeing across the board?
So as we discussed, I think the entire banking and finance sectors, including the insurance company, I would say is a good hedge against inflation. Actually, that sector benefits from some amount of inflation because as we know and have seen historically that banks, the repricing happens on the asset side first and liability reprice with gradually. So we can see probably some NIM expansion, hence the net interest margin remains same. We will see some amount of credit growth picking up, which plays out very well for the banks as well as NBFCs, and even for insurance companies. The valuations are very attractive, and they also benefit from this overall whatever has happened in last 2 years, etc. So I think this is the sector which one can play to benefit from this, or I mean, as a hedge against this inflation.
Okay. Atul, this show essentially what we do every Friday is we welcome in a lot of live viewer engagement as well. Some questions have started trickling in, and I'd like to address them as well and want you to address them for our viewers who are primarily retail investors. One of our viewers wants to know about the GDP forecast that was given by the RBI governor today. Talk to us about how do you see things playing out, because the revision is phenomenal, the downward revision, especially when it comes to growth. Inflation has been revised upward. So investors, the ones who recently entered the markets, definitely are very jittery right now because they don't understand something like this. They've not experienced something like this firsthand.
Yeah. So while economy is very important and growth is very important, like we have discussed, inflation and economy and macro stability, etc. But it is very important for retail investor or as well as institutional investor like me is that stocks or the businesses make money and not the economies. So economy is obviously the enabler, but the opportunity is really large. And even if the growth forecast is getting down from 7.8 to 7.2, etc., the companies which are in good momentum, business-wise, I'm not talking about stock momentum, the business momentum is strong, which companies which are getting sort of market share or gaining market share, I think those companies are the ones one has to bet on rather than worrying about the economies and the interest rates and inflation, etc. Because ultimately, opportunity size is big and some companies will continue to do well. And we have enough number of examples of companies doing well for last 10 years, 20 years and through multiple cycles. So I think these things are important to track as an enabler because they provide the opportunity. But ultimately, the focus in terms of if one want to create serious wealth, the focus should be on selecting right companies and staying invested with those companies.
One more stock that saw some positive momentum earlier this week was auto stocks. Last week, of course, the first of the month, numbers started trickling in. There's a lot of action happening, in fact, in the overall auto space, whether it's moved towards sustainable fuels, alternate fuels, or whether it's demand and innovation and technology, etc. Are you guys also looking at it in the positive light, or do you think there's still some time before auto picks up meaningfully?
Yeah, we are looking at auto sector positively, and we have increased allocations since the start of the year. When the news about the semiconductor or chip supply started getting normalized, around that time we have increased some exposure to ancillaries as well as four-wheeler companies. We are still not looking at two-wheeler in a major way because the risk of electric vehicle disrupting that industry is much, it can happen much earlier and can also result in change of the industry structure. Like for last many years, we had 3 players in two-wheeler side. Now probably there can be 6, 8 players, and obviously number of players going up or industry structure changing is not, at least as of now, is not looking good. So we are staying with the four-wheeler companies, passenger vehicle companies, where the risk of disruption because of EVs is not yet sort of very imminent, at least in next 5-10 years, because the product itself is complex, and companies there are also active in terms of developing products, electric vehicle, passenger vehicles. So we are looking positively at this space, but one has to look at these sort of peculiarities and select the stocks accordingly.
Okay. Well, the earnings season is just a few days away. Q4 earnings is an important one. They will also give the whole year performance as well with it. IT, of course, is the one that's going to kickstart. IT bellwethers will be giving in their numbers, TCS, Infosys, etc. It has been a bit slow when it comes to the IT stocks. Last few months, the rush and the resilience that they've seen in the last 1 year, compared to that, in the recent past, it has been relatively quiet. So what is your understanding of how the IT sector is playing out and how Q4 will unfold?
So whatever interaction we have with the experts like ISG and Gartner, and as well as with IT management, we gather that the demand continues to be very strong. Obviously, when one starts looking at YOY numbers, at some point of time, the YOY growth rates will sort of normalize, because if whole of CY21 or FY22, we had very good sort of demand in terms of pent-up demand, or people or the clients going for the transformation projects, etc. At same time period, and that has resulted in solid growth. But once we move ahead, I think that base effect will catch up, and the growth number will normalize, but it will still be much better than, say, last 3-4 years. So that is on demand. The real worries are coming on the margin side now, because of this demand itself and the attrition level going up in the industry. Salary levels are obviously moving up, and that is putting sort of pressure on the margin. So because the demand will sort of normalize now and margins under pressure, what we have seen in last 3 to 5 quarters in terms of upgrades happening after every quarter results, that cycle may take a breather going forward for IT companies. And unless we get positive surprise or upgrades, the stock doesn't move easily. That said, I think the companies will continue to deliver steady growth in this volatile kind of moment, which itself is a good achievement. So I think the stocks will probably give us compounding style of return in line with the earning growth each and every company delivers.
One of our viewers wants to know, Atul, mid-cap or large-cap blue-chip IT, where is your preference? So
on growth as well as margin, these two front, what we are gathering is large caps will be able to manage the margin in a better way, while mid caps will continue to see good growth going forward. That is also because the projects which are coming from the clients are smaller in size, and mid caps are actually doing a much better job in terms of grabbing those smaller projects, because for large cap companies to move the needle, they need to get bigger deals, and that is sort of not happening for last 1 or 2 quarters. So it is a mix of both. While mid cap will continue to deliver better growth, on margins they will face problems, while large cap, though the growth will normalize faster, on margins they will deliver in a much better fashion than mid caps, because of the inherent ability to manage margins because of the scale they have. So again, there is no clear answer, but one has to look at company by company basis while selecting large cap and mid cap from the IT space. But there is no blanket, one answer like one has to prefer large cap or mid cap. It again has to be stock selective.
Overall for Q4, Atul, what is your outlook? Who will be the big winners or the big outliers for the quarter gone by? And more importantly, do you think the companies will actually sail through this quarter and the real problems will start trickling in from Q1 and Q2 onwards? Is that correct?
Right. You're, exactly right in terms of saying that this quarter companies will manage, because most of the companies have some kind of inventory in the system. So they will sail through in this quarter, and demand is still pretty good. Though in January it got impacted because of Omicron, but whatever we gather from the intelligence, that in March there has been a good catch up. So in terms of demand as well as margin delivery, 4Q will be sort of average. The real test will start going forward from Q1 and Q2 when the higher cost inventory will come into the system and put pressure on the margins. And at the same time, companies are still taking price hikes. I mean, whole of last year they have taken price hike. In this quarter also, they are taking price hike. So at some point of time going forward, we will see this price hikes impacting demand. So going forward, the real test will start in terms of maintaining the growth momentum as well as sort of maintaining the margin or reducing the margin pressures. So you're right, this quarter will be okay. We are already seeing a lot of pre-quarterly, particularly from financial side, they are reporting good growth. But going forward, I think we will see 1 or 2 quarter of sort of sluggish top line as well as lower margins.
So do you have any favorites for Q4 who will do well this time around? Any sectors or buckets that you've would like to indicate?
Yes, I think we are again coming to the same point again and again. I think banking and finance space where we are going to see sort of positive surprises, and we have seen a lot of pre-quarterly releases by banks as well as NBFCs, and they have reported 20 to 30% or even higher kind of loan growth YOY. Obviously, these are good companies which has reported and they have grown this much because of market share gains. But I think overall we will see positive surprise from this space rather than any other sector or theme.
I want to know your view on commodities, specifically metals. Very volatile. They have rewarded a lot of investors on the street, and they have been few casualties as well of traders who have not been able to make it big by trading in metals. How should new investors who are just starting their investing journey, how do you pick the right metal stock? How do you ride the commodity bull run that we're in?
You're right that many investors have missed this rally because at any point of time, it is very difficult to build confidence in this metal prices and how long it will last. That is always a big question because of the variables involved in this sector or theme. So I would say this metal rally has started around say 12 to 18 months back, and the prices has gone up, metal prices has gone up, and most of the stocks also have gone up almost like 4 to 6x. So I would say in this kind of environment, and after seeing this kind of movement in the metal prices and the stocks related to those metals, it is very sort of dangerous to extrapolate this move. Probably the prices will sustain at these levels for some time, but extrapolating this move that oil has gone to 100 and now it will go to 150, or in case of aluminum which has moved from $26 a ton to $3,500 a ton, extrapolating it and saying that it will go to $4,000 a ton, it is very risky strategy. So I think at such point of time, one has to take a sort of view of mean reversion, that at some point of time in future, the prices will start to mean revert or come down, rather than extrapolating, because that is going to be a lot riskier thing. So I would say if somebody has missed, one can stay away from this kind of stocks rather than getting into them now and chasing the momentum, because it can backfire at any point of time. But I don't know when it will sort of come down. It can stay at these levels for 1 or 2 quarters or even 3 quarters. It is very difficult to predict this kind of commodities and sector moves, especially given the situation we are in. So I would say there are many more alternatives. So why to sort of take this kind of risk? That is my overall approach to investment, because we should first look at margin of safety rather than chasing the stock momentum.
Agree. I want to zoom out and give our viewers a macro view of the benchmark indices and the overall broader market, what's happening there. Because we've largely been witnessing a range-bound trade in the last couple of weeks. Is that now going to be the overarching trend where markets will continue to trade in that narrow range? And more importantly, is this a good time to invest, or would you advise people to watch how this plays out and then dip in at a level that they're more comfortable in?
Yes, I would agree that market will probably remain range bound for some time to come, because first we have come a long way since the COVID bottom, from almost 8,000 Nifty to 17,000 Nifty now. So valuations are looking fair, and we are seeing and going to see the challenges of raw material inflation, commodity inflation for the corporates as well as for the economy itself. So probably there will be some period of cool off or range bound movement on the market side. But as we discussed earlier, that India's macro stability is established in a very firm way in terms of stable yield, stable currency, etc., which bodes very well for the market. And the companies, though they will face some margin pressure in say next 1 or 2 quarters, ultimately most of them should be able to pass on through taking price hikes. And the last thing is, some amount of inflation is always good for the corporates as well as government. So corporates will pass on, and the top line will start looking better because they will grow some volume and they will also get price hikes. So the growth in top line will look good. And also we are seeing the government, the tax collection in terms of GST as well as other direct, indirect taxes, they are looking very good. And inflation in commodity is one of the reasons why tax collections are so good. So I think while there is pain in certain section of the economy, these are the benefits of this kind of inflation. And because government is getting good tax collection, they will be able to invest in the economy or plow back those gains into the economy and keep the momentum going. So I would say, last point is, we are seeing the worst of the war, commodity prices and all those things. And if the view is that after some time it's going to normalize, then market should continue to do well. So I would say market will be range bound in maybe 1 or 2 quarters, but this is a good phase to accumulate equities, because whenever things start to normalize, there is a good possibility of sort of resuming the up move which we were seeing for last 1.5 years.
Atul, earlier this week, we had a few big global banks flag off recession. You had Deutsche Bank, then even Goldman says that the risks of a recession are rising. How does an investor sitting in India get impacted? Should they be worried?
I think, if at all the recession hits globally, obviously we will also see some problems, because our exports can take a slight hit because of that recession. Not a big hit, because we are still gaining market share. So our export story is not directly linked to global growth. It is also a story of getting market share away from China particularly. So that will continue. So to a large extent, I think we will not get impacted directly because of global recession, because it is still a market share gain story. Obviously, it will have an impact on flows, etc. But if you look at last 2 years, the domestic flows itself are very strong and resilient. And I think I don't see any reason why the flows should dry down materially. I think that momentum has started and probably will continue. The domestic flows will continue to come into India, into equities. So even though those kind of predictions are coming in from global banks, I would say India will continue to shine brightly, and hence it will reflect in the market as well. And the thing is, if at all the fears of recession, etc., come back, though I'm not expert in this field, but if at all the fears of recession comes back, we have to see how the Fed changes its language or the course which they have said in terms of rate hikes, etc. Because in last 6-8 years, whenever such kind of fears came, Fed had to backtrack and stop their rate hike or the balance sheet tightening cycle. So I think there is no clear answer or very concrete answer about this Fed rate hike, the global recession, growth, etc. So again, I would rather focus on what's happening in Indian economy, and particularly on what's happening with the companies which we invest.
But barring banking and financials, you haven't really talked to us about any other themes or trends that you guys are betting on right now. Anything else that investors are perhaps missing out amid all the market chaos?
Yeah, so banking and finance, obviously, we are pretty bullish. The second part is the consumer discretionary part, including auto. So I agree that these companies will face margin pressure because the commodities and oil prices has gone up. But most of the companies, at least we have selected, they have strong franchise in terms of brand and distribution, and they have exercised the pricing power significantly in last 1 year. So most of these companies, though they are expensive, I would like to continue holding on to those companies, because last 5 years we have seen that starting from demonetization, NBFC crisis, GST implementation, COVID 1, 2, 3 wave, and now war. These companies are getting stronger and stronger because their competition is just not able to deal with so many variables and volatility. So I would certainly stay with this kind of companies. Within that, I might change the preference, but I think this discretionary related to home improvement or auto, etc., I will stick on to that. I'm also bullish on or have significant overweight on the cement sector in my portfolio. As I said, government will continue to invest in the economy. Real estate is picking up, at least in terms of volumes. We have seen in metros and as well as in tier 2, tier 3 cities, individual home building is happening. So cement will continue to find a lot of sort of demand drivers, and they are also exercising power whenever possible. I mean, they are also facing a lot of input inflation, but I think pricing power also is there. So we will stay invested in the cement.
Okay.
Lastly, we have certain exposure to pharma and chemical companies, which are gaining because of China plus one. Indian promoters, I mean, in those sectors are doing very well on their own. And also the global growth, at least now, is looking firm. So to that extent, these chemical companies and some of the pharma companies can do well. So these are the 4 overweight buckets in our portfolio as of now.
Well, Atul, I would have loved to chat more, but we're pressed on time. But I'm sure our viewers are taking back lots from today's conversation, lots of good ideas, trends and developments to watch out for. Pleasure having you on board. Thank you once again for joining in, and to our viewers for tuning in. Have a great weekend, everyone.